Distinguished guests, ladies and gentlemen, a very good morning. Let me begin by thanking Mr. Suman Berry and Mr. Manish Jain for very insightful addresses. I also want to thank ET Edge Global Sustainability Alliance for inviting me to share my thoughts on the crucial subject of financing India's green transition. We meet at a very defining moment in India's growth story, as you would all agree. Driven by the government's visionary policy framework, India today is the world's fourth largest economy and is poised to become the third largest by 2030 with a projected GDP of $7.3 trillion. On the other hand, climate change poses one of the most urgent challenges of our time. India ranks 6th in the 2025 Global Climate Risk Index, reflecting the vulnerability to climate impacts. Between 2019 and 2023, India incurred damages exceeding $56 billion from weather-related disasters, with the 2023 Himalayan floods alone causing losses of over $1 billion in Himachal Pradesh. Rising temperatures could erode 5.8% of India's working hours by 2030, and changing monsoon patterns may cut GDP by 2.8%. Lowering living standards for over half of the population by 2050. India must therefore strike a balance between advancing economic fundamentals, supporting developmental needs, and building a low-carbon, climate-resilient economy. The government has signaled strong ambition, a commitment to become a net zero by 2070, updated NDCs to reduce emission intensity of GDP by 45% by 2030, and achieving 50% cumulative installed capacity from non-fossil fuel-based energy resources by 2030. Financing India's ambitious climate commitments requires channeling structured financial flows towards long-term energy transition, including investments in clean energy, biofuels, green hydrogen, breakthrough technologies in energy storage, and towards decarbonizing hard-to-abate sectors such as steel, cement, and agriculture. Estimates suggest India needs over $10 trillion by 2070 for infrastructure and technology pathways to transition high-emitting sectors. By 2030 alone, 1.3% of annual GDP would be required to substantially decarbonize power, steel, cement, and road transport sectors that together account for over half of our emissions. Steel and cement would alone need $392 billion by 2030, and while power sector requires $57 billion towards additional capex for decarbonization. And road transport requires $18 billion for EV adoption and charging infrastructure. This scale of finance requires a recalibrated financial architecture, one that incorporates climate risks, balances risk-return profiles of green versus brown investments, and unlocks new investment opportunities for a low-carbon future. But there are challenges in mobilizing green finance flows. Global climate finance remains inadequate. In 2024, flows touched $2 trillion, about one-third of the investment needed globally. In India, the annual average climate funding for climate mitigation stands at roughly $50 billion, meeting only 30% of requirements for NDC targets. Green finance flows remains afflicted with several challenges: lack of standardized definitions, difficulties in assessing project viability, investor aversion due to risk and information asymmetry, high upfront costs, and long gestation periods. The banking sector faces similar challenges in accelerating green finance at scale: high cost of capital for emerging technologies, a limited pool of bankable projects, and limited underwriting experience in areas such as climate adaptation and circular economy. Apart from the size of the funding pool, distribution is also a key concern. Most climate finance flows to developed economies, while less than 15% reaches emerging markets. Within flows, more than 90% goes to climate mitigation, leaving climate adaptation severely underfunded. And yet, adaptation projects such as resilient agriculture, water systems, and urban infrastructure are essential for protecting vulnerable communities. Similarly, there are imbalances in sectors other than clean energy and transport. Hard to abate industries remain underfunded, despite being critical to India's growth, largely due to technology costs, uncertain revenue models, and limited access to concessional finance. Additionally, green finance deployment requires verification and assurance of use of proceeds, adding capital costs and often making green investments less competitive. So let me give you my views on the strategic pathways for accelerating green financing. The following 7 core enablers are of utmost importance in scaling international and domestic flows, and the government has already taken initiatives, actions on some of these. First, define green. A foundational piece is a clear definition of what qualifies as green for credibility and comparability. The Ministry of Finance's climate finance taxonomy will play a crucial role in enabling proliferation of green financial products. Second, a central green finance authority. A dedicated green finance authority could consolidate standards, address market barriers, and support commercially viable project pipelines. With policy support, large-scale renewable energy generation became commercially attractive. Similar interventions can unlock sunrise sectors. Third, put a price on carbon. Pricing emissions compels polluters to reduce pollution and invest in cleaner alternatives. India's carbon credit trading scheme, with mandatory reduction targets for all high-emitting sectors, will be crucial in financing low-carbon technologies. Fourth, standardized climate disclosures. Standardized reporting addresses data gaps. SEBI's BRSR has laid a strong foundation, and RBI's draft framework on climate-related financial risks is a welcome step towards expanding disclosures of key metrics. Fifth, expand bond markets. While green bonds dominate, globally the ambit of sustainability instruments has expanded to include social and sustainability-linked bonds. SEBI's proactive measure to expand the scope of ESG debt securities framework to include blue, yellow, transition and sustainability-linked bonds will deepen the bond markets. Sixth, strengthen verification ecosystem. Reliable third-party verification enhances trust. Upskilled chartered accountants in sustainable financing accounting can help in making verification accessible and affordable, especially for MSMEs. Seventh, build institutional capacity. Financial institutions must integrate climate risks into decision-making. Building capacity to understand climate issues and design innovative financial mechanisms is critical to scale green finance. So what is the role of banks? At the center of the green finance ecosystem sits the financial sector, carrying fiduciary responsibility and serving as the first responder to both risks and opportunities. Banks must upgrade traditional risk models to account for environmental externalities and bring risk-return profiles of green investments closer to traditional ones. Global green financial mechanisms such as sustainability-linked loans, MSME-friendly structures, and blended finance tools should be adapted to Indian realities. Transition finance roadmaps must be developed for hard-to-abate industries, particularly those under pressure from compliance carbon markets. Partnerships with DFIs and MDBs can provide concessional layers and expertise for partially bankable projects, particularly in climate adaptation. But banks must also look inward, modernizing risk models, integrating climate considerations into portfolio management, investing in climate data infrastructure, and piloting products even with imperfect data. Above all, capital flows must link to measurable socio-environmental outcomes such as jobs supported, water saved, emissions avoided, aligning finance with India's developmental priorities. In the end, let me talk a bit about Yes Bank's experience in this space. We at Yes Bank have established a long-term climate roadmap integrating actions to reduce operational emissions, measure and limit financed emissions, and support climate-aligned sectors. The bank pioneered the Indian green bond market in 2015, going on to raise $260 million through 3 issuances for financing renewable energy. In a bid to integrate climate considerations into its business, Yes Bank was the first Indian bank to measure and report financed emissions of its electricity generation portfolio, later setting decarbonization targets aligned with well below 2 degrees pathway. The bank continues to support climate-aligned sectors like renewable energy and clean transportation and has developed targeted products for green financing. Yes Bank makes detailed disclosures on its ESG and climate performance in line with national and international benchmark disclosure frameworks, for which it has consistently earned a leadership position amongst prestigious global ESG ratings. In FY 24-25, for the third year in a row, Yes Bank achieved the highest S&P Global ESG score amongst Indian banks and was the only Indian bank to be included in the S&P Global Sustainability Yearbook 2025. The bank is also the highest rated Indian bank by CDP for its climate change disclosures 3 years in a row. In conclusion, the Indian economy is at a point where it needs to grow quickly, but the challenge is to figure out how to incorporate climate considerations into commercial lending and investment decisions, while balancing the needs of credit expansion, economic growth, and social development. While proactive policy support and regulatory intervention have given India a significant head start, active participation of all stakeholders is needed to increase the momentum for achieving our ambitious climate commitments. Thank you.